Okay, in this lesson we're going to talk about the domino effect, and this is for Forex traders who follow a lot of different pairs and currencies in the market, like we do with our trading system at forexearlywarning.com. The domino effect this is our most advanced topic. The thing you have to remember is this: it's a little bit hard to explain. This is a really good article that will help, but the domino effect, generally speaking, starts with a couple of currency pairs or one, and then it starts spreading to other pairs as the market dynamics change from day to day. The way to identify the domino effect is you have to have some basics and fundamentals in place. We follow 8 different currencies at Forex Early Warning, like 7 pairs in each group. So we follow 7 of the Japanese yen pairs and 7 of the US dollar pairs and 7 of the Canadian dollar pairs, etc. So we follow 28 pairs total. So the basics you have to understand and know would be multiple time frame analysis and parallel and inverse analysis. You can click on either one of these links here to find out more about those basics. Once you know about these basic things, and how currency pairs don't move independently of each other, they move pretty much dependently on each other, and they move in groups, I think you'll start to understand the basic concepts of the domino effect. So if you're a Forex trader and you treat an individual pair like it's an island all by itself with no outside influences, you're pretty much destined for failure. Now, most Forex traders trade the Euro USD, but they're not analyzing all of the Euro pairs or all of the USD pairs to try to understand what is influencing the movement. And you can apply the domino effect to one pair. You can apply the domino effect to any group of currency pairs or the entire market. So what causes the domino effect to occur? The thing is, you got to remember is that if a currency pair like the pound USD goes down for 6 or 7 days and it starts to stall at support, it needs to make a decision at that point if it's going to continue downward or start to cycle back up. If that pair starts to cycle back up, you have to start to monitor the British pound pairs and the US dollar pairs to see what's influencing it to cause it to possibly move back up. So if you have several other British pound pairs start moving up, then chances are the pound USD is going to go up too off support. But you're not going to know any of this unless you're monitoring several GBP pairs or several US dollar pairs. Remember, the pound USD or any other pair is not operating independently of the rest of the market. So one of the best ways to explain the domino effect is just by looking at examples. So we have example number 1 here, all the way down through example number 7. We'll cover some of these examples right now. You can read about the rest of them. Let's cover the first one in a detailed fashion. So, for example number 1, let's say all the Japanese yen pairs are cycling up and down in large ranges. That would mean that the Japanese yen is in control. So these pairs have finished a down cycle and they're now currently stalled at support. So here's a little example. We're talking about ranging pairs. If you click on that link there, a pair that's ranging is cycling up and down in a range. So the yen pairs cycle down and they start to hit support. They're sitting down here at support, and you're thinking there's a pretty good chance they'll start to move up. And so you're starting to monitor the yen pairs to see what's going on. Well, here comes the Asian session. And all of a sudden, because of the influence of the Aussie dollar and the New Zealand dollar, the Aussie yen and the New Zealand yen, they start to move up first. They start to cycle up on a fairly big time frame, like the H4 or D1 time frame. They start to cycle up and build a new upcycle. Well, later on in the European session and the US session, The pound yen, the euro yen, and the Swiss yen, they start to cycle up too. So they're following the Aussie yen and the New Zealand yen up in a domino type fashion. Then you get into the U.S. session. Maybe there's some Canadian dollar news, and then the Canadian yen starts to move up. Then eventually the USD yen starts to move up. Well, the Japanese yen weakness starts in the Asian session, and then it spreads to the rest of the JPY pairs. You can see this, it's obvious on the charts, and so the domino effect, the first dominoes to fall are these in the Asian session. The reversals start on the yen pairs, and then it just continues. And if you can see this happening, you can get in at the beginning of the movement cycle confidently and maybe ride these up cycles for 5 days, because these pairs are cycling in like a 5-day range. We're working with the higher time frames here. So this can happen on the US dollar pairs too. The Aussie USD and the New Zealand USD, they might start to move up in the Asian session. Be the USD pairs in this example. And then when the main session starts, the Euro USD starts to rise also, and the USD Swiss and the USD CAD, they would start to fall because the US dollar is on the left. And it just spreads to all of the USD pairs. But it started with a couple of pairs, and if you have your chart set up correctly, you can see this happening. You can see the reversals starting, and you'll be able to catch the movements on any or all of these pairs and trade much more confidently. So that's a great example of the domino effect. In the second example, the movements start in the main session, and then it spreads to the next session, which would be the Asian session. So in the main trading session, the Euro USD, Pound USD rise, and the USD Swiss and USD CAD both fall. That means that the US dollar is weak in the main trading session. But later on, in the Asian session, there's a news driver on the Forex news calendar, on the economic calendar, from the Aussie USD, from the Australian dollar. And after the news, the Aussie USD starts to rise. So it's playing catch up, or equalizing the movements that occurred earlier in the day from the Pound USD, Euro USD. And the USD weakness finally hits the Aussie USD. Once again, it's the domino effect, session over session, trading session over trading session. You can also use support and resistance breakouts to predict what pairs are going to start moving next. So let's say the Euro USD and the Aussie USD are trading sideways, and the market is a little bit choppy. Well, then all of a sudden the Euro USD and Aussie USD, they break out of important resistance areas in the main trading session. Well, the USD weakness is coming into the market on several pairs, like 4 pairs in this example. Well, if the Pound USD is sitting at resistance, okay, if the Pound USD is sitting at resistance, and the very next day there's some British pound, news driver or something like that, the next day the Pound USD is going to break in the same direction up as the Euro USD and Aussie USD, because it has to also catch up with the rest of the movements on the US dollar pairs. Once again, this is the domino effect day over day, but you're using resistance breakouts to figure out what pairs are going to start moving and what pairs are going to move next. So you can set up some basic moving averages. Just click on this link right here. Set up these moving averages. Set them up exactly the way we show you how, by individual currencies, so all the USD pairs are together. And you'll start to be able to look at these pairs all very differently than what you do now. Okay. Let's look at this example also. Here's some more examples here. You can read these on your own. We'll just cover this last example here. This is an interesting example. This is the reserve currencies and the commodity-based currencies. We follow 8 different currencies with our system. Okay, three of the currencies, Canadian dollar, Aussie dollar, and New Zealand dollar, are all based on commodity prices. They're called the commodity-based currencies. The remaining five currencies are reserve currencies, like the US dollar and the yen. So, in this example, the pound Aussie, pound Canadian are moving sideways. Okay? Well, the pound Aussie and the pound Canadian are moving sideways. They start going up and start building new trends. So what do you have here? You have the British pound strengthening against two of the commodity-based currencies. Okay? So the pound Aussie and the pound Canadian were moving sideways, and then they start to go up and build new trends. Well, what pair is going to move next? Well, here's your commodity-based currency. So if the British pound is strengthening against two of them, the next pair that's likely going to go up, the next domino to fall, is going to be the pound New Zealand. You can almost bet it's going to go up next. Now, a lot of people don't think that the Forex market has any predictability to it. The Forex market has a lot of predictability to it if you start to analyze the market this way. So, if the pound is moving up against all of these three currencies, that's starting to exert quite a bit of pressure on the British pound going against the reserve currencies. So, once these movements have occurred, now the British pound is starting to get a lot stronger, and it could easily spread to the British pound against the other reserve currencies, like the British pound against the US dollar, Swiss franc, or yen, where your reserve currency is the currency on the right. Okay? So, it can also happen in reverse. You can have the pound USD, pound Swiss, and pound yen go up first, and then it spreads to the pound Aussie, pound CAD, and pound New Zealand. So, now this is not at all how the how Forex traders think. Forex traders, they look at one pair, they have technical indicators on it, and they're not even looking at any of this stuff. And they don't have any type of logical clue at all as to why currency pairs are moving the way they do every day, or why they're choppy. But the fact of the matter is that movement, it begets more movement, because you have billions and trillions of dollars flowing in and out of these currencies every day. And if you start to pay attention to what the whole market is doing, you'll start to see where the inefficiencies are. Then the efficiencies will come in and correct the market, fix any imbalances. And if you use, these basic techniques, like multiple time frame analysis and parallel and inverse analysis, you'll be able to analyze all 8 currencies, and you'll actually start to be able to predict, or at least have a much better idea of what currency pairs are going to move next, and introduce some level of predictability to the Forex market. So this is Forex trading, the Domino Effect. It's one of the lessons in our 35 lesson package from ForexEarlyWarning.com.